Hey guys, what's up? Welcome to another episode with me, Shashank Goduppa. And in today's episode, I am going to look at 5 companies that will become debt free and has a good growth potential. Now, I know a lot of you guys have asked me, Shashank, please go deeper into companies. Let's understand more. So I'm here to give you all that knowledge out as well. So guys, I have a very special announcement to make. So on 5th September, which is Teachers Day, I am going to be coming live for 2 hours and I will do a masterclass in stock market for anyone who wants to learn. This is beginner to advanced. I will be teaching you concepts of what we use in our RA desk, how to build screeners, how to look at companies, how to deep dive into companies, a framework for investing as well. And all of this is going to be just 99 rupees. Now I'm going to make it even better. All the money that we collect from this 99 rupees, I'm going to donate it to fund a child's education. I've already done it last year, but all the proceeds from this 99 rupees is going to go into a donation to fund education for a child, because I believe education is the most important thing in the world. So if you are interested, I'm going to put the link here. There's only going to be limited slots on this, but it'll be a 1.5 hours to 2 hour session and it is going to be amazing. Okay, so I hope you guys are excited for it. Now let's go into the session. Now, what are we going to look at? I'm going to look at 5 companies that are becoming debt free. Now, what is the reason of debt free? Now, a lot of people say that Shashank, becoming debt free is a good thing. There is two sides to the coin. Right? I would like my company to have some debt because leverage is the best way to grow. I myself love debt so much. In my own personal account, I have a lot of debt, but my debt goes only into assets. If I have 100 rupees, I will ensure I take another 10 rupees of loan, put it in the asset as opportunity cost today, and then with my future cash flows, I pay off that debt. Now, here I want to look at companies that are debt free, but do they really need CapEx to grow? Number one. And if they are debt free, are they going to put new manufacturing plants so that the revenue can also grow as well? So that is what I want to understand. The third thing is, if they don't need a capex plant and they're debt free, that means I will get a lot of cash in the company and that cash can come to me in the form of bonus or dividends. So today we're going to cover 5 companies. One is specialty chemicals and adhesive, one is in the defense space, one is an API and CDMO player, one is a wire and cable company, and the last one is a capital market in fintech. So let's go deep into it. Now, the first company is actually Pidilite, and we did a deep dive into this company. And Pidilite basically is in specialty chemicals and adhesives. Now, if you look at Pidilite, you've heard of Fevicol, Dr. Fixit, and this has been a consistent compounder for a very, very, very long period of time. Right. So if I quickly show you Pidilite over here, it is a 1,68,000 crore market cap sitting at 63 PE. And in the last 10 years, you can see it has given around 16.8% compounded, which is not bad at all, right? And if you look at the free cash flow of this company, in the last 1 year, it made 2,000 crores of free cash. And in the last 5 years, 7,890 crores of free cash. And the dividend payout is also quite interesting. And if I go here and check the balance sheet of this company, as you can see, they have 10,000 crores in reserves, and they barely have any kind of borrowings, right? So whenever the borrowings are not there, it can actually start growing even further. Now, if you look at the financial performance, even in the quarter-on-quarter perspective, they have been growing very attractive, which is shocking for a company. Even at this scale, they are actually growing very well on a quarter-on-quarter basis, right? So this quarter, they had a growth. As you can see, last quarter, they had 10% growth. This time, they had a 21% growth. I'm trying to find companies that are going to be growing and going to do better, right? Even if you look at the PAT, 678 to 884, so they have been growing very well. And obviously, they're very strong return on capital employed and return on equity. Both margins are also very, very good, right? Now, they usually have different growth categories also. So mainly what they're seeing is that their adhesive business, right? Tile adhesive business, waterproofing under Dr. Fixit are all B2B based work, and all of this are growing faster than the Fevicol business. So that Dr. Fixit that we see is actually one of the fastest growth drivers of this company. Then my team actually went into the con call, Q1 FY27 con call, and basically they said that volume growth came with the price increase. So what happens is, if I am selling, let's say Coca-Cola for 10 rupees and I sell 100 bottles, and next day I increase that 10 rupees to 12 rupees, my sales will go up by 20%. But if my bottles also go from 100 to 200 and my price goes from 10 to 12, then I get volume growth and price growth at the same time, which will explode my earnings. So basically that is what they were saying, that the consumer and bazaar volume basically went up, both volume also went up and revenue growth also went up. Gross margin expanded. Input cost, obviously everyone is having problems with input costs. So that is something that is there. And both halves of the business basically started growing very aggressively, right? And now they're saying that if you look at the FY27 market, they are very bullish on this market. and the management is basically only looking at raw material inflation, mainly because of the war, the freight charges, and any global supply chain disruption. That is what they are basically concerned about. Now, if we do a quick technical analysis of this as well, because we are an all-round investor, we can see that Pidilite has actually, obviously, over a long period of time, it has grown. But since the last few years, let's say from September 2024 to now, it has given basically zero returns. Now, after 2 years, it has basically come back to its all-time high zone. And that is something that is very interesting to look at. In fact, we can see a very strong momentum coming from this zone as well. It took a rejection at 1700, which is the all-time high zone, and it went up all the way from 1200 to 1700. So some kind of momentum is being played out right here, and that is what we are looking at. What is the interesting part about growth? One definitely is the brand moat and the category leadership. Second, their B2B projects are doing well right now. Balance sheet is, because it's zero, they are looking for acquisitions, and they can also be very aggressive on capex expansions and new products, right? And pricing power, though, they already have, because they have the ability to pass the extra pricing onto the customer, because they are one of the best in the space, right? Only problem is if you look at the valuation, because our job is to look at both sides. If you look at the valuation right now, the valuation is quite expensive. So if you look at the 10-year cycle, it was always trading at 96, 99 during the bull run, which I would not say is an average. Right now it is at 60. In my book, 60 is still expensive, whatever said and done. And I would like it somewhere around 35 to 40. That would be a very good zone to buy. But yeah, it is slightly expensive on that side. Cool. The stock number 2 is Bharat Electronics. Again, a very interesting company. BEL is basically a defense company that manufactures radars, communications, and it's one of the biggest players in the space. And if we look at the revenue has also been growing quarter on quarter, and the balance sheet is also completely zero. They barely don't even have anything over there. Now, let us do a quick fundamental deep dive into Bharat Electronics. Yeah, so it's a 3 lakh crore company. It's at 48 P. That means the growth of the P ratios are good. That means a lot of sales are coming in. Free cash flow in the last 5 years become 8,400. Free cash flow is 560. Again, if you look at this company in the last, obviously 10 years it has flying, but in the last 1 year it has been flat, means it has been consolidating. But the defense sector growth, we all know, is only going to go up from here. And if we look at the quarter on quarter sales, we have seen that the last 4 quarters there has been some good growth. This was because during this time there was election season, and the government procurement orders were not coming for all defense companies, and now the government is starting to procure and also export, which is where BEL comes into this picture. And you can see that the growth of this on a year-on-year basis has also started doing well in the last 4 years. It is a completely cash-rich business, and obviously that's why they give very nice bonuses, very nice dividends, bonus issue in 2022, buyback bonus. So anytime a company is cash rich, they will definitely give some kind of bonuses as well. The order book of this company is 73,000 crores as of 1st April, which is 2.7 times its revenue. Means the revenue will keep coming in as well. And these companies usually work in 2 areas. One is product sales and one is AMC after the product sales as well. So again, that is interesting. They've done some joint ventures as well with aerospace companies, and their export order book now has gone to 465 million. I told you this, right? That export order book is something that everyone is working on, all defense players, because we have now come out as a defense exporter, as a cheap defense exporter. So that is basically coming in as well. And that is very interesting. Now, only one problem here in the con call we saw was UR-SAM, which is basically the quick reaction surface to missile thing, which is basically got delayed by the cabinet. And I told you this, that most of this has been delayed, but we definitely need those SAMs for border safety and border control. In the con call, they also mentioned about the guidance, and they have reaffirmed that the guidance is going to be 15% growth, and the EBITDA will be around 27 to 28% margin, which is basically positive. And order inflow of 55,000 crores is going to come, including QR, quick responsive SAMs, right? So again, we're very interested to look at that. And they're also in the AMCA space, which is the stealth fighter that we are going to build. And these are the things that can basically drive growth. What is the problem? Just like every defense company, all defense company have this order timing problem, right? So sometimes the order might come this quarter, sometimes it might get delayed to next quarter and then move on to another quarter. So that is a problem we are seeing again across the board. And that, I would say, is the biggest problem of defense companies. Now, coming to technical analysis, let's do of BEL. Let's not forget, all 3 we will cover. Okay, fundamental, technical, thesis. As you can see, BEL today is at negative 200-day moving average ke bhi niche hai. As you can see, it has definitely gone up over a long period of time. Now, for long-term investors, there is no problem, because if you see it from a long-term time frame, it's fine. The game is that the defense thesis should continue. And if the defense thesis continues, then this stock is available at below 200-day market cap. Again, it's not a buy or sell recommendation. It's just to see, because all the time people say that, Shashank, you only show stocks that have gone up. I'm showing you stocks that have not gone up also. But then that is a problem with usual retail investors. If I show you something that is at all-time high, you'll be like, Shashank, it's already gone up. Show me something that is down. If I show you something that is down, you'll be like, all these stocks are bad. They're all down. So there is no perfect way to enter and exit over here, right? That is the best part of life. Okay. Coming to another company called Divi Labs. Now, Divi Labs, by the way, is one of the largest players in the space for generic APIs. And also the promoter of this company is highly regarded across all fund managers in India. And they always do very good things, right? So if you look at this company, again, this is a company that was not doing well in the past, in the recent past. After COVID, they actually had a big slump. And then after that, they started doing really well. So I'll show you the fundamental analysis first. If you go to the quarterly highlights here, you will see that in this point, now they have started getting 27% growth year on year. And this is usually the best quarter, June quarter. 27% is the quarter on quarter growth. And the margins have gone from 30 to 41%. And I'll talk about all of this as well. The PAT has literally doubled, right? And if you look at the balance sheet of this company, completely clean, no borrowings at all, complete reserves. And this is very good for acquisitions as well. Now, if you look at the stock price, it has recently, I told you, it did a very bad phase where it went up post-COVID. I'll show you in 5 years. It went up post-COVID, and post-COVID, wow, it's been so long since COVID. It went up post-COVID and then fell down from 5,300 to 2,500. Literally 50% went in a large cap company. And from 2,800 today, it is at 8,500. This is the beauty of compounding, right? When the stock, every stock, if you look at any stock in history, it always falls by 40-50%. The guy who can hold it at 40-50% is the guy who will really win, right? So again, this company does all the contract manufacturing. And if you look at all CDMO companies, they're doing really well right now, and they're growing quite aggressively. And basically their custom synthesis business gave 60% of the revenue, and generic business gave 40% of the revenue, and a continued shift towards higher margin, because custom synthesis is a higher margin business, right? And it's also stickier because the contracts are long term. And these guys have very good plants all across India. And when FDA, which is a US foreign administration, comes and checks everything, they are usually very good. They have a 3-month rolling inventory strategy. That is something that they spoke about in their con call. Margin drivers are also doing well because they're going towards better custom synthesis. Double-digit growth, but can be lumpy, is what they're looking at. Now, one more thing that is happening in US is something called Biosecure Act. Now, Biosecure Act basically means a lot of companies in US were sourcing APIs from China, and a lot of drugs were being remanufactured in China as well. So now they're saying we will stop all of this from China, and we will start taking it from other countries where India benefits the most, because after China, we are one of the best pharma exporters in the way, right? Capacity runway is also coming, because now they're getting into peptide synthesis also, which is your GLP-1, Ozempic kind of drugs, right? So they're getting into that, and if that starts blowing up, then they're going to be doing really well. But as I said, this is not a smooth compounder like your Cipla and Torrent Pharma or Sun Pharma. They will be very volatile. If you look at Torrent Pharma, they have a very smooth curve. Cipla has a very smooth curve, but Divis will be up and down depending on the projects that they get. Now let's do a quick technical analysis also on Divis. As you can see here, I was tracking it as well. So Divis recently did an all-time high breakout after a very long consolidation period of 1 year. It did a breakout, and after the breakout, it has just gone straight up to the moon, right? 22% after the breakout. I will wait for it to retest. I think a retest is definitely on the cards. And usually what happens in pharma companies, don't measure them by P ratio, which many people do mistake. Don't measure pharma companies by P ratio. We look at something called price to sales ratio or market cap to sales ratio. Now, this company is sitting at 20, which is the market leader. And I would say it is pretty stretched. Price to sales is also pretty stretched over here. As you can see here, it is at its 10-year high, all-time high. So I would say right now is not a good entry point. Just be careful, let it come down a bit, but it is very premium right now. So that is something you should be very aware of. Okay. Awesome. Coming to another company, Polycab India. Now, all the wire companies are doing phenomenally well. You talk about Polycab, you talk about RR Cable, you talk about KEI Cables, you talk about Dynamic Cables, you talk about Apar Industries. Everyone has been doing phenomenally well. That's because this whole construction boom that is coming in, with the electricity boom that is coming in, all cable companies are doing one of the biggest growth drivers right now. And I will show you that as well. Okay, we'll do a quick study on the fundamentals of Polycab. And in fact, Polycab has not gone up as compared to the other companies. That is why I'm showing you. Now, if you see Polycab, it's sitting at 48p for a market leader, which is very fair, right? And if you look at this company in the last 5 years, it has definitely gone up. And in the last 1 year, it has now stagnated at 10,000 has become a very big barrier for this company. Now, same way I'll show you, let's say APAR, you will see how APAR has gone. Same way I'll show you KEI, you will see how KEI has gone. All these charts look very similar. You talk about RR Cable, right? Another company in the, see, look at this. So Polycab is not started its journey yet, but I believe any moment it should start. And if you look at this company, it is a beautiful, consistent compounder, and the sales are growing at a rapid pace, mainly because of what I told you. The whole sector is now booming. All wire sectors, at least for the next 3 years, in my opinion, should do well. And if you look at the company, it is absolutely debt free. It barely has any debt. Long term borrowings are only 39. The rest of it is like rental and lease liabilities. That's it. So this is again very interesting, something to keep your eye on. And these are companies that actually start doing really well. Now, if you look at where the money is coming from, the money is coming from wires and not cables. Wires grew at a single digit rate ahead of cables, and the annual share showed that this is going to increase as well. Solar is basically one of their biggest engines that is coming in. Data centers, tower and distribution, which is where APAR Industries, all of these guys kick in. They started doing EPC contracts, which is engineering, procurement, and construction outside, overseas as well. So all of these things are coming very interesting in this company. And their EPC order book, BharatNet and RDSS, they give some revenue, visibility into the company as well. So we are looking at this more from a 3-year standpoint. And I told you all these companies are very interesting. I would say Polycab is not very cheap, not very expensive compared to the other companies that are there. Now, finally, the last company, which is a capital market company, a cash-rich company, is called KFintech. Now, there are two companies in this space. One is KFintech and one is CAMS. Okay, now a lot of people ask what is the difference between the two. They both operate in the same space, but KFintech is actually doing better than CAMS, mainly from the capacity that they're building, because KFin is backed by a PE company and they're going and doing acquisitions not just in India but also outside India. So they're not just an India player. As you can see, after 2025 acquisition of 51% stake in Singapore-based Ascent Fund Services, KFin has expanded into global fund administration. So in India today, whenever someone makes let's say a PMS or they make an AIF, they have to go via KFin or CAMS, and usually they prefer going to KFin as well. So let's do a quick fundamental analysis of KFin here. KFin. KFin is actually not a very rich company. It's a small company, 16,000 crores, 49 P, and market cap to sales 11. In fact, it has gone down by 15% this year. But the cash flow of this company has been very, very rich, right? And if I look at the company, you can see it here going down. Again, you told me don't show companies that are only going up. I'll show you companies that are down but fundamentally good. And if you look at this company, what has happened in the past is this company is doing very heavy acquisition. So it is doing an acquisition-led growth. Organic growth is not great, but they are buying companies left, right, center to actually grow their sales. So even though the sales looks very amazing, it is mainly because the number of acquisitions that they do, and they have a lot of money even now to do acquisitions. So that is what they're doing left, right, center. And if you believe that the domestic market of India will grow, then this company from a long-term perspective has a lot of advantages. So who owns this company? It is General Atlantic Singapore Fund. General Atlantic is a global PE firm and they basically own this company. And if you see, a lot of DIIs and a lot of FIIs basically have stake in this company as well. So it is a company that is constantly doing acquisitions left, right, and center, and that is something to look at. Again, acquisitions have two things: one is good and one is bad. If the good side is, if they do a good job on the acquisition, then it becomes very revenue positive. If they do a bad job, it becomes a problem. But they are now going international, mainly to play the whole international fund management game. And I believe, because I'm in the same space, I believe the international fund management industry will also fly very soon. I mean, I think for the next 15 years, I don't think there's any problem there. So their core segments is domestic mutual fund, investor solutions, largest RTA issuer solutions, IPO also they help with, NPS they help with. International momentum is where this game is now starting to come into the picture, which is again going to be very interesting. And now they're moving away from just mutual fund, whereas CAMS is only still in India and not expanding outside, whereas this company has gone outside as well. And they are saying that this is going to be a transformative year. The international footprint now is into 18 different companies, and the international business grew 100% year on year and now almost 20% of overall revenue. So there will come an inflection point and then we will all see KFin going up, and then you will remember this session that you actually had, right? Mutual fund yields fell roughly 2% quarter on quarter. Management said that because the shift from debt funds to lower liquid funds, the rest of the contracts are okay. So Ascent, which is the company that they bought in Singapore, it operates at a very low EBITDA margin of 7 to 8%. And KFin's core business is basically 40% EBITDA margin. So that is why there is a gap. But the growth of revenue that can come from Ascent over a period of time will be very aggressive. So they are saying that FY27 target is 23-24% and EBITDA they are continuing to maintain 40. And they're saying that even though the SIP inflows are good, Nifty 50 has not gone up, so we want to basically go up. The world's first product for mutual fund SIP processing within 3 working days was highlighted as a technology differentiator. As I said, CAMS has become a little old school. KFin has become the faster growing business, and India's SIP and mutual fund growth, if this keeps going up, KFin also will start going. Again, it's a very cheap company. It's a 13,000 crore market cap company, but it's a bet on the future of the mutual fund industry in India. And if that does well, then definitely everything looks good. Again, I know these are slightly longer videos, but you get a very quick summary of all the interesting companies in one frame. So I hope you guys enjoyed this video. And if you did, please click on the like button and also subscribe to the channel if you're here for the first time, because we give very good content like this. And also don't forget, we're doing a Teachers Day masterclass. I'm going to put the link in the bio as well. You can come and join it. It's only 99 bucks, but you will get a lot of learning as well. This is me, Shashank Gorupa, signing off. Take care. See you. Bye-bye.